Thank you for joining me. I want to talk a little bit today about negative market volatility and things that you need to understand about it, what's happened kind of in the past, and maybe how you can use it to your advantage within moving forward. All right, let me go ahead and share my screen. So before we get started, I want to just go through and give my little bit of disclaimers saying that this information that we're going to cover today is my information, my knowledge, my thoughts. Please don't make any decisions or changes to your investment strategies without sitting down with a professional or maybe with us and talking one-on-one so that we can strategize and make sure that we're making those adjustments for this information based off of exactly what you're trying to accomplish, okay? So these are just my thoughts and my feelings as far as how we do things with our clients. Okay, let's jump into it. So negative market volatility, I think you first have to understand what a correction is, okay? So corrections are actually a good thing and they're normal. There's different types of corrections. So you may have a pullback, which is the market moving backwards 5 to 9%. It's actually a correction once it goes 10 to 19% backwards. And it ends up being considering a bear market once it's 20% or more, okay? So let's put this into context a little bit so we can understand what's actually happened in the past. There's been 27 corrections. That's where it's moved back 10 to 19%. There's been 27 of those of the S&P 500 since 1945 to 2022. So that's an average of basically every 2.8 years, we have that type of a movement back. And as I said, that can be good because as the market descends backwards or as it comes down in volatility situations, that is the time to buy because that's when everything's on sale, right? If we constantly keep buying when everything is high, if it doesn't continue to go up further, then we've actually defeated the purpose and we bought high and now it's going to drive down lower. So volatility is actually a really good thing and we want to make a lot of moves when we're during those volatile times. 5 of those market corrections since 1974 have actually turned into a bear market. Now, we might be really close to seeing another bear market and being number 6 in 2022. But as of right now, since 1974, there's only been 5 of those bear markets. I want to talk a little bit about this slide because it shows quite a period of time from like 1942, I believe it is, all the way through to 2020, the bear markets and the bull markets that we've had. And one of the things I want to point out here is look at how short of a duration the bear markets have been, right? Whereas the bull markets last for much longer periods of time. So we have to be able to control our emotions in that, but we have to make sure that we can stay steady as we're going through some of these bear markets. The challenge is that as the market starts to go down, we start to have these thoughts. Is it ever going to stop? How far down is it going to go, right? Am I going to lose everything that I have in there? And then we start listening to our neighbors and our family and the news. And oh my gosh, everybody's up in arms over how bad the economy is doing and where the market's going. And like, be patient. It'll come back. It really, really will. And if we take a look at it, and again, with these bull markets, the idea is that we want to try and get in when it's a bear market, right? When it's down so that we can go through and ride that bull portion up. It was interesting because I went over to the university to help as a assistant pastor for one of the financial classes. And as I walked in the back of the room, the class had already started. I was not late though. I went on my appropriate time, but I walked in the back of the room and the professor had one of these bull market times up on the wall, and he actually had expanded across the entire wall. And it was funny because he was standing right up against the wall and he was looking up at the positive rates of return, and then his head was going all the way down to the negative, to the up, to the negative. Okay, because you see, it's not a smooth line. It's a bumpy, right? And he's just head jerking up and down, up and down, up and down. And as I came in, he said, "Hey, Pat, what do you see from back there from the beginning to the end of this bull market?" And I said, "Well, I see an even climb up." Because looking at all these bull markets, what has it done? It has gone through and moved up pretty much on a decent, steady arcing type of line. Even if we look all the way back here up, We're still an arcing up movement. It's just, it's been a very bumpy road all the way through there within time. This, I think, will explain a lot of it. And I love this particular slide because this shows the absolute worst starts of the markets in different year categories. So taking a look at where was the market in February of these different years versus where was it out just basically in the next 10 months. So look at this, in 2009 being the winner of the worst starting first 2 months at a negative 18.1%. That was in 2009. Look at what it did 10 months later, 54.6. 54.6. It moved up quite a bit, right? I would not have been wanting to stand on the sideline during that timeline. Would have loved to have been buying in here and riding it out to this point. In 1933, that was the next worst start of the year, negative 17%. In 2008 at negative 9.1. I'm sorry, this 17 negative. Look at where it ended up, 85.6. Look at 2008, a negative 9.1. And in 2008, it did not get better, a negative 30.7. Could you imagine 2008, if you were in the market dealing with that, in the beginning of the year, you were down, and then by the end of the year, you're still down even more. That would be really hard to try and keep your emotions working positively for you, right? Because how far down is it going to keep going? And if you're in it for the long haul, that you're not needing this money right away, then okay, it will come back around. And let's look at that example. In 2008, it was down 30.7%. What happens right after 2008? We have 2009, which was at the top here. So it was 30.7 down. 2 months later, it was at 18 down still, but it actually recouped half of its gain back in an upward position to end at negative 18.1, and then just a few months later at 54.6. Okay, so you have to try and remember some of these numbers and what history has done to go through and understand that that is going to probably happen in the future. But here's what ends up happening so much of the time. We call it investors' dyslexia. We preach and preach and preach about buying low and selling high. And yet as the market peaks and starts to drop down and starts coming down, this is where we're seeing a lot of people that are not working with a professional investment advisor. They're going through and letting their emotions get the better of them, and they're selling out on that downward slide. And then as the market starts to come back up, they're buying back in. And that is absolutely just backwards to what we're saying, because they're now going through and selling low and buying high. And that is not a way to beat this market strategy. You want to do just the opposite of that. So here's the 5 things to go through and do during the time of volatility. Number 1 is be patient. It will at some point turn around and correct. You just need to be patient. If not patient, be aggressive. If you have money, it's time to buy in, right? Don't overthink it. It really, looking back at history, is pretty simple to not overthink. If the market is down, volatility is hitting, buy in. If you've already bought in and the market is down, then just stay put and wait it out till it changes. Resist your emotional instincts, right? It's not a fight or flight type thing when it comes to this. Be patient, wait it out, it'll turn around. You want to always stay diversified. And if you're right now not feeling that you're very diversified, you're kind of uncomfortable, then sit down and actually go through and reassess where your situation is, okay? Let's talk about COVID a little bit. When COVID hit in March of 2020, and the market really bottomed out because everything shut down, if you were invested in different companies that have to do with any type of entertainment or travel, restaurants, those types of entities really had a hard time. And we'll call that the service sector, right? Because people couldn't travel, people couldn't go out of their home, people didn't want to go out of their home. They wanted to stay home and they wanted to have all the activities they could possibly do at home. So at that point, if you would have, as things were going down, decided to move your holdings out of that particular sector and decide to move it in, where would you have moved into? Well, if you think about the fact of people staying at home, it meant that they were using their computers a lot more. So cybersecurity probably would have been a really good investment to go into, because prior to COVID, it had not been doing very well. Companies that go through and do these videos would have been a great area to go into, because most people weren't doing all kinds of video work and getting out to their clients. A lot of different companies didn't even exist that are now really jumping into the stream. We have the technology to where students can do school from home, employees can work from home, doctors can see their patients from home. Man, just the whole technology side of things would have been really great to have gotten into. And maybe Amazon and Home Depot would have been kind of some nice buys too, because hey, everybody was doing their honey-do list and fixing, and everybody was shopping from home, right? So you just can kind of use a little bit of common sense as to see like what's actually going on when this volatility is hitting, because I'll tell you, every time somebody's losing money, somebody else is probably making it. Just understand that in whatever situation you're in, the bear ultimately retreats. And you don't want to be sitting on the sideline when the bear retreats, because you want to be able to be on that bull and ride that bull up. I'm going to finish with this. We go through and talk all the time about these 5 areas with our clients. Right now, today, we're talking a lot more about investments, right? And I'll tell you that it boils down to this. If your income is pretty strong, whether you're working or you set up on Social Security, pension, you've got other vehicles that are paying you income, that's awesome. But if your income is a little bit weak and you're needing to pull from your investments, that's when this starts to get really fearful, right? So we want to go through and make sure that we can set up the investments appropriately to make sure that the income is not faltered, okay? If you guys already have really super great income and you're not needing the investments that much, then you don't have to be that aggressive. We always want to make sure that we're not paying any unnecessary tax, and there's ways of establishing investment strategies that will really help you out in the future based off of the tax basis. And I'll tell you that if these 2 areas are in sync with each other, man, it really helps you to decide where to really be doing your investments as to how risky or how conservative you can be on the investment strategies. And we want to go through and make sure that these 3 areas stay in link with each other so that we don't run out of money before we run out of time. And at the end, we want to make sure that we can pass the loved ones our money rather than passing it through like probate or estate planning, what have you. So it's really through taxes. It's really important to do that estate planning to make sure that you have it all set up. And so this circle just continues to keep going around. If this makes sense, you have not done it, or you're not sure if you've really got it all set up completely appropriately, you could always give us a call if you want, get in touch with us. We're here. We're more than happy to listen to where you're at right now, maybe help you tweak some things and move forward. You do not have to become a client to talk with us and see if there's a way to tweak a little bit of what you're doing now. Or if you even want to put together an entire plan, we can do that for you too. We're more than happy to help out. I hope this has been helpful. I hope it's maybe got you to think a little bit differently, to be a little bit more patient, to make sure that we're always buying on the low side and selling when things are high. Don't wait for a correction on a downward slide to then jump out of your holdings. Not a good thing to do. If you've already done that, make sure you get back into the market in a timely fashion. You don't want to be sitting on the sidelines when we start to hit that bull market. Thanks for joining me, and until we talk again, be safe.